Good afternoon, everyone. Thank you for joining our webinar series today. My name is Tyson Mavar, one of the ExxonMobil focused retirement advisors for the retirement group in Texas. And on today's webinar series, we're going to cover one of our favorite tax strategies for ExxonMobil employees, one known as Net Unrealized Appreciation, or NUA for short. This is a tax strategy that will allow many employees to save a substantial amount of taxes on their ExxonMobil stock in the 401k plans. For those of you who aren't as familiar with our company, the Retirement Group is an independent financial planning organization that specializes in working with corporate employees in an effort to plan for retirement, transition successfully into retirement, and to manage retirement assets in the most sustainable fashion possible. We're not affiliated with ExxonMobil, nor are we endorsed by ExxonMobil. We happen to use Charles Schwab as a custodian, whereas your administrator while you're working at ExxonMobil is Voya, of course. We have a whole host of complimentary services that we highly recommend you take advantage of, whether or not you are a client of ours or maybe are even considering becoming a client of ours. Not only these webinar series that we have an ebook library that has some fairly easy to read retirement strategies, some specific to ExxonMobil employees, some generic to retirement taxes and retirement rules. And we have a whole host of other complimentary services. One that will probably give you the most benefit and be the best exercise is our cash flow analysis, where we'll take your current resources, take what you expect your expenses to be, which of course we're happy to help you start to identify what those changes might be when you retire. And we'll put it into an analysis or a retirement plan that'll help you confirm that you're on track to meet your goals and what things to look out for given your circumstances as you approach this eventual transition from the company. I'll give you some ways to reach out to us at the end of today's webinar series in the event that you are interested in speaking with us or having us run any of these projections. One of them, specific to today's talk, is the Net Unrealized Appreciation analysis, where given some assumptions we can start to help you figure out how much tax savings are you likely to enjoy based on your company stock, the cost basis, your tax bracket status, and a few other variables that will be different from person to person. We're delighted to spend some time with you on a complimentary basis, as long as you're willing to spend a few minutes with us. Net Unrealized Appreciation, a fairly complicated strategy that, to put simply, is a way that you can pay a lower tax rate on your ExxonMobil appreciated stock, specifically the capital gains tax rate, as opposed to the ordinary income tax rate, which is much higher in most cases, and the tax rate that you will pay if you withdraw money from your 401k plan, or if you roll over your 401k to an IRA and withdraw money from the traditional IRA. But if we could take some of our 401k and get it into an environment where we do not have to pay ordinary income taxes, it could be a substantial long-term benefit to you and many of the people that we've talked to at ExxonMobil. Now, there are some potential detriments to this strategy that we want to watch out for, and put specifically, the main two are the inability to defer taxes on your ExxonMobil stock. If you decide to take a portion of your ExxonMobil stock and utilize Net Unrealized Appreciation, you will have to pay immediate taxes on just the cost basis of the shares that you utilize this strategy with. The other detriment being that you will have some taxes immediately on your dividends from this stock. Now, the benefits here are the lower tax rate, the capital gains tax rate. Your dividends will also be taxed at a lower rate in most cases, which is the qualified dividend tax rate, versus, again, the ordinary income tax rate, substantially higher for withdrawals on IRAs for almost everybody. And everybody's situation, like I mentioned earlier, is a little bit different. So we have to look at, to start, the table that's at the end of your statement on your Voya statement. It's called the stock cost basis by dollar range. And this shows the cost basis of all the shares you and the company have purchased while you were an employee at the company. Even if you started your career at Mobil or XTO, they're going to keep track of your former company shares and the cost basis that came into the plan once the merger happened. And these old shares oftentimes have the best tax saving opportunity because they carry the lowest cost basis. So let's go through an example of one individual. We have Lucy Norton here, an individual who, when she retired and did her rollover, also known here as the in-kind distribution, which just means that she chose not to sell her stock shares when she retired. She chose to move them over in kind so that they went over to the custodian without being sold. Her total value of her shares was $200,000 when she did her rollover. The cost basis on those shares, which this is the average of all the shares. The neat thing about ExxonMobil is they let you look at the individual share cost basis and choose which shares that you utilize for NUA. In her case, the total cost basis of those shares was $50,000, giving her net unrealized appreciation of the difference, or $150,000. Now, for this example, we assumed that she kept her shares for 10 years after she left the company, that those shares appreciated to $400,000. They doubled over a 10-year period, which would be just barely over a 7% average return during that 10-year period. And we also assumed that she was married, and her husband, in this case, filed their taxes jointly. Now, I'm going to break this down a little bit more detail here. This bar on the left here, we have the composition of all of your stock. There's going to be 3 different segments of the value of your stock that the IRS is going to look at. You can see at the bottom here there's a small amount that's called income tax. That would be the cost basis on those shares, taxable at ordinary income rates. The income tax is taxed immediately when you do your rollover, the year you do your rollover. In some cases, why we recommend waiting to do your rollover, not necessarily the year you retire, maybe the year after you retire, or maybe several years after you retire in some cases. Then you have above that the long-term capital gains tax rate. The dark blue is also known as the net unrealized appreciation, which was the growth during your career, or at least prior to doing your rollover and the NUA strategy. Now in the light green, we also have long-term capital gains that are applied to the growth after you did your rollover. But the reason we differentiate these is because the future appreciation, there's an additional potential tax savings wherein if you pass away and you still have appreciated shares in your non-qualified account because you did this net unrealized appreciation strategy, these future capital gains will disappear, at least under the current tax law, on something called a step-up in cost basis. If you pass away and have appreciated assets, whether it's a home or stock in this case, your beneficiaries will get a step-up in cost basis, which means those unrealized capital gains will disappear and not be taxable to your beneficiary, whoever that might be. It could be a spouse, could be children, could even be a cause or a non-individual. Unfortunately, the NUA long-term capital gains do not disappear as a result of the step-up in cost basis, so that's why we've separated them here. But does create an additional benefit of this strategy, certainly under the current tax rules. Off to the right, this bar chart goes through the ordinary income tax brackets under current tax laws, and you can see the higher your income is in a given year, the higher your tax rate goes. Oftentimes, this is where it helps to do some retirement distribution planning to make sure that you're minimizing not just this year's taxes, but your lifetime tax bill. And it oftentimes doesn't make a lot of sense to take too much money out of an IRA in a given year if you can avoid it. And sometimes we'll actually recommend our clients borrow money or avoid paying off debt in a given year if they can help their tax situation. In some cases, it makes sense to pay less in taxes, even if it means paying a little bit more in interest to a bank or lender. So with this framework, now we can start to identify how is this strategy going to save somebody, in this example, Lucy Norton, some money on her retirement benefits after she left ExxonMobil. So in this table, we have 2 columns here, the NUA strategy, or if she just kept the money in the 401k or rolled it all over to an IRA and paid taxes slowly over time as she removed the money from her IRA. So example 1, she utilizes the NUA strategy. She does have to pay $50,000, well, she doesn't have to pay $50,000, but $50,000 goes to her taxable income for the year, and she's going to have some taxes on that in year 1, the year that she does her rollover. Income tax in our progressive tax system, like we saw in the last one, it's a higher rate on the amount that's above $20,550. So on average, she's paying a little over 11% effective tax on this $50,000 of income that is taxable on the cost basis of her shares. So total taxes due, $5,589 the year that she does her rollover. Then we assume that she liquidates the stock 10 years later. Now she's going to pay capital gains taxes on all of those shares, some of which there is no taxes owed, the first $83,350, because of the capital gains tax brackets also being progressive, meaning the more capital gains you have, the higher your capital gains tax bracket actually goes. But she is going to pay 15% capital gains on the amount above $83,351 up to $517,200. So her total taxes due when she sells her stock is going to be $52,500. Add that to the original taxes she paid on the cost basis, so her total taxes associated with her ExxonMobil stock was $58,089. All right, off to the right, let's go to the scenario where she does not utilize NUA. She rolls everything over to an IRA or just keeps the money in her 401k. It would be the same from a tax perspective. No taxes immediately. That's the benefit of doing the rollover, or I would say the detriment of doing the NUA strategy is the immediate taxes. However, when she pulls money out of that account, whether it's all at once or slowly over time, which is usually most common for retirees, just supplementing your Social Security or maybe a future job after ExxonMobil, we assume that she sold her stock and withdrew $400,000 10 years after she retired. Well, that would be a pretty high income, I would say, for most of our clients in retirement. So she is actually paying a higher tax rate because she took a lot of money out from her IRA in one specific tax year. So some of that is actually being taxed at 32%, a much higher rate certainly than the 15% that she was able to lock in on her capital gains if she did the NUA strategy. So her total taxes in this keeping the stock in a 401k or rolling over to an IRA scenario is $128,000, comparable to the barely over $58,000 in the NUA strategy. In her situation, this saved her close to $70,000 in taxes because of the lower capital gains tax rate that she enjoyed on her ExxonMobil stock by utilizing the NUA strategy. This is not uncommon for our clients. I have one client that has substantial appreciation in his stock. He actually recently sold some in his brokerage account. He retired about 4 years ago now. Sold some, locked in capital gains, much lower rate for him and his spouse. Something else to keep in mind too is that if your total income goes over $250,000 per year for a married couple and only $200,000 per year for an individual filing single, there's something else called NIIT, or net investment income tax, which creates an additional tax on both capital gains and your qualified dividends. It's an extra 3.8%. So this is again where it helps to do some thoughtful tax planning to understand when you're selling appreciated stock, what is the big picture? How is that going to affect your ordinary income taxes? Should you maybe consider deferring the sale of the stock or spreading it out over several tax years? All of these things will play into putting together a strategic income plan that minimizes the amount of money you have to give up to the government, and doing it completely legally, just being thoughtful about how you navigate the rather complex tax code that we have in this day and age. All right, let's talk about the interest rates really quickly before we wrap it up today. You can see the IRA segment rates have increased dramatically since the end of 2021. They have started going back down a little bit in the last couple months, so this has helped folks that are still at the company and haven't commenced their lump sum pension. Lump sums have gone back up a little bit. So you know how the company looks at these rates, they're actually going to use the 4th and 5th month prior to the quarter you commence your benefit. So for instance, if you are retiring this year, or maybe you retired last year, just haven't taken your pension yet, but you commence your pension in the 2nd quarter, which would be April 1st, May 1st, or June 1st, They're going to be using the December and November rates. They'll blend them together to get these average segment rates. And although the November rates were pretty high, December rates have gone down, and we've actually seen, although not published yet, the January rates are probably going to be even lower. This could be a reason to maybe defer your retirement or defer the election of your pension. If you can predict that the rates are going to be lower, you might make some money on a very low risk basis by deferring the commencement of your pension into this potentially the third quarter. We don't know what those rates are yet. We should know in the next week or so at least what the January rates are, but the third quarter rates won't even be based on January. They'll be based on February and March. So stay tuned to future webinar series, and we'll let you know what's happening with these interest rates, because it could mean, like we saw some of our clients that just weren't financially or psychologically ready to retire last year, lose close to 30% on their lump sum. Some of those folks are now considering taking part of their pension as an annuity. Some of those folks are still planning on the lump sum, but they're planning on working a little longer to make up for the losses, but also excited to be investing in an environment where interest rates are higher on their fixed income investments, annuity payouts are higher from private annuities, and stock prices are a lot lower now than they were a year ago. So it might be an even better time to be investing in stocks, certainly at least compared to 1 year ago. So those are the things that we wanted to focus on. Unfortunately, what we found statistically is that 74% of Americans over the age of 50 do not have a written plan for their retirement. This is critical, folks. There's no excuse for this, especially since our company and many companies out there will do this for you for free on a complimentary basis, just in an effort to spend some time with you so that you can get to know them and how they might be a good bet for your business when you get to retirement. Take some time, folks. Statistically, they also say that we will spend more time planning our vacations than we will our own retirement in our life. So consider retirement as the best and longest vacation of your life. Spend a few minutes to make sure that your money is going to last as long as it needs to, which is at least the rest of your life. And we're delighted to do that for you on a complimentary basis. Should you be interested in spending some time with us, whether it's to do the cash flow analysis or just talking through some of your questions on some of these more complex issues with the benefits, you can email us at info@theretirementgroup.com. You can call us at our home office at 800-900-5867. You can also take a picture of this QR code to get onto mine or one of my coworker at the retirement group who understands the ExxonMobil benefits, get onto one of our calendars, so we can hopefully help you improve the probability of success on your retirement plan by just understanding some of these rather complex issues and getting ready for what may be the biggest financial decision of your life, which is, of course, your retirement. So with that, we do have a few questions that we're going to go through before we wrap it up today. Question 1, what are the triggers to be able to utilize NUA? Great question. We didn't have a slide for this, but in order to correctly utilize Net Unrealized Appreciation, you have to have gone through a triggering event. And those 3 triggering events are retirement, 59.5, and death/disability. You have to have met one of those, technically 4 milestones to be able to utilize NUA. Now, retirement doesn't always come first. Sometimes 59.5 comes first for those folks that work past 59.5. So what does this mean? Well, if you pass a triggering event, that just means that is no longer an opportunity to utilize NUA. So, if you, let's say for instance, are with the company and you're over the age of 59.5 and you retire, now you've met a triggering event, and what that means is that if you pull money from your retirement account, from your 401k in the case of ExxonMobil, you have to utilize Net Unrealized Appreciation by the end of that tax year, otherwise that triggering event is lost. So for instance, let's say you left the company, you are over the age of 59.5, and you withdrew some money from your 401k plan. You haven't done the NUA strategy yet, but you just took some money out. Many of you know you can only take money out once per year for most employees from the Voya plan. Another reason that a lot of people will roll their money over to an IRA at some point, just to have more withdrawal flexibility from that account as well as investment flexibility. But for this individual, they've already passed retirement, they already have the 59.5 triggering event, and they pulled money out. If they don't do the NUA rollover by the end of that year that they took the money out, Now they have to wait till death or disability to have another triggering event to utilize NUA. So you have to be very careful when pulling money out of your account. And this is why it's critical to have an advisor that understands these issues, so that when you are talking to them during your quarterly or however often you review, going through your situation and what your plans are, they can protect you from making an otherwise fairly detrimental and irrevocable mistake potentially within your retirement plan. So great question, appreciate that. We didn't have a slide on it, so we at least had a chance to cover it. Question 2, once retired, can you take stock dividends without triggering a withdrawal event, jeopardizing the NUA option? Great question, a good segue from the last question. This is something that there is not clear guidance from the IRS on. However, I have had clients that they left their stock and their entire 401k in the plan after they retired. Usually it's because they retired before 59 and a half and we're doing something known as post 55 withdrawals. This is where you can get penalty-free withdrawals from your 401k even though you're not 59 and a half. However, if you take withdrawals, like we talked about earlier, that's going to create a trigger and you have to utilize NUA by the end of the year. Otherwise, it's going to go to the next trigger event. Well, this question was, can I take my dividends out? Is that going to trigger a withdrawal? And although there is no clear guidance on this, we have never had a client who did not get through an audit that essentially did not allow them to use the NUA strategy. In other words, they do not classify dividends as a distribution from the plan. This is similar to how you may be taking dividends from your stock while you're working and not reinvesting those shares. You can continue to do that in retirement. Although, remember, those are taxed as ordinary income because they're coming out of the plan. If you were to utilize the NUA strategy, get those shares out of the 401k and into a non-qualified brokerage account. It could be an individual account, could be a joint account you own with your spouse potentially. Those distributions, those dividends specifically, would be at the qualified dividend tax rate, for most of you 15%, versus ordinary income taxes, which may be a higher rate. One of the benefits of this strategy, reducing your taxes on your dividends. Great question. Question 3, I am retiring this year and have company stock in my 401k. Under the NUA rules, can you roll only the stock into a IRA account, then use NUA? A good question. I'm not sure I fully understand the question here, but I believe what they're asking is, can you keep your stock shares when you move them out of the 401k? And the answer is yes. In fact, like I mentioned earlier, most of our clients, or at least me with my clients, I recommend waiting until those shares get to Schwab so that we can put a game plan together once their shares have moved into, usually some of them to an IRA, the high cost shares, the low cost shares going to a brokerage account or a non-qualified investment account. And then from there, we'll decide how many shares do we want to sell, if any, what price are we comfortable with. Maybe we'll put a limit order, say that, maybe my client likes $120 a share. They think that's a reasonable share price to sell a quarter of their shares, just for example, to get them down to a more reasonable long-term allocation so that we don't have too much money in any given stock, including ExxonMobil. Well, we'll put a limit order at $120. If and when the stock hits $120 a share, it'll sell those shares. Versus when those shares are at Voya, you can't get the price the day that you call to sell the shares. Oftentimes it's the next day's price. Sometimes it's 2 or 3 days later that those shares will be sold. So you're kind of going in with some mystery price, and if the stock declines during that time, fortunately you're going to be stuck with a price that's a lot lower than what you expected. So based on this question, yes, you can move your shares out of the plan, but you have to do a total distribution when you utilize this NUA strategy. You have to fully have distributed that 401k plan by the end of the year. So what most people do is they just clear the account out in the same transaction, all in the same phone call, where Voya will send your non-qualified, your NUA shares to ComputerShare. Then they go to the custodian, Schwab in our case, but it could be any custodian. After they reach ComputerShare, they keep the cost basis so you know what you have to pay capital gains on in the future whenever you sell those shares in the future, but you don't have to sell them immediately, and most people don't anyway, just so they can be more strategic on how they sell the shares after they leave the 401k and once they get to the custodian that individual chose to work with in retirement. Question 4, what disqualifies you from NUA? Well, I mentioned earlier, talking about the triggering events, if you take a distribution, you could disqualify yourself from net unrealized appreciation if you don't have another triggering event available. Now, everybody will always have that death triggering event available, but you may not want to wait until you are dead or disabled to utilize this strategy. So definitely recommend being careful taking money out of your 401k after you've left the company, because you no longer have that retirement triggering event available to utilize this strategy. And by the way, you cannot utilize this strategy while you are still working at the company. I've heard that question many times. Something else that may more subjectively disqualify you from NUA is having too high a cost basis in your shares on your ExxonMobil stock. The lower your cost basis, the less upfront taxes you'll have, and the more appreciation you'll have on those shares, which gives you more of a tax savings, given that it's just the appreciation on those shares that carry the lower tax rate on capital gains versus ordinary income. So if you were buying shares at too high a cost basis, or if you sold all your shares at some point and then the shares that you have now were purchased at a higher cost basis, strategy might be difficult to justify. Or if you're expecting a really low income tax bracket in retirement, this is not the case for most people I work with, but that could be something that might disqualify you or might make an argument not to do this strategy. There's a lot of moving parts in here, and it's critical that you run an analysis before you go through this, of course, hopefully several years before you're retiring, because it might encourage you to start saving money on an after-tax basis inside of your plan, or even doing what they call a special contribution, where you write a check to Voya, contribute money toward the end of the year, usually is when this is done, to get up to certain contribution limits and put money into the after-tax bucket, whether that's for a Roth rollover when you retire, or applying this after-tax money toward the cost basis, or what they call paying down the cost basis of your shares, can help you out a lot on taxes once you get to the point where you're retiring from the company and utilizing this NUA strategy, rolling over your 401k to an outside custodian from Voya. So those are all the questions that we had today. Thank you everybody for attending our webinar series. Again, if you have any questions, feel free to call us. If you'd like to set up a meeting or just want to talk about your situation, let us know. With that, everybody have a good, safe rest of your week, and we hope to talk to you all very soon.